There is a number that makes banks nervous, not a number that's illegal, not a number that triggers an alarm the moment you deposit it. Just a number, sitting quietly in your account, that puts you on a list you didn't know existed, monitored by people you've never met, under rules that were never explained to you. And the unsettling part? The people most likely to end up on that list aren't criminals. They're people like you, people who saved their money, kept it close, and thought they were being responsible. $20,000, that's the number. And if you have that much sitting in cash, or if you've ever moved that much through a bank account in a way that felt perfectly normal to you, what happens next is something most people never see coming until it's already too late to stop it. Here's what nobody tells you when you open a bank account. You assume the money is yours. You assume that as long as you earned it legally, paid your taxes, and followed the rules, the bank is simply a place where your money waits for you. A vault with your name on it. But that's not what a bank actually is. Not legally. Not in the way the system actually operates. When you deposit money into a bank, that money stops being yours in the traditional sense. Legally, you become an unsecured creditor. The bank borrows your money, uses it, invests it, and owes it back to you, on their schedule, within their rules, monitored by federal regulators who have the power to flag, freeze, and investigate any transaction they deem unusual. And unusual doesn't mean illegal. It just means it doesn't fit the pattern they've built around you. This is the system. And it runs quietly in the background of every financial decision you make. After 9/11, the United States passed the Patriot Act, which dramatically expanded the government's ability to monitor financial transactions. Banks became the frontline surveillance mechanism. They're not just holding your money, they're watching how you use it. Every deposit, every withdrawal, every transfer. They are legally required to file what's called a Suspicious Activity Report, a SAR, whenever they believe a customer's behavior falls outside normal patterns. And here's the part that should stop you cold. They are legally prohibited from telling you that they've filed one. You will never get a letter. You will never get a call. You won't know it happened. But somewhere in a federal database, your name is now attached to a report that could follow you for years. And that word suspicious is doing an enormous amount of work in this system. Because the legal definition of suspicious has nothing to do with guilt. It has nothing to do with intent. It simply means a bank employee looked at your account activity and decided it didn't match what they expected from someone like you. Now you might be thinking, fine, I don't do anything suspicious. I work, I save, I spend like a normal person. This doesn't apply to me. That's exactly what the people this happens to always think. Because here's the twist, and this is the part that changes everything. The real danger isn't the government. It's not the Patriot Act. It's not even the SAR system. The real danger is a behavior so common, so reasonable sounding, that millions of people do it every single month without ever realizing what signal they're sending to the institution holding their money. It's called structuring, and most people who do it have never heard the word. Structuring is the act of breaking up financial transactions, usually deposits or withdrawals, to avoid hitting a reporting threshold. The most well-known threshold is $10,000. If you deposit or withdraw $10,000 or more in a single transaction, the bank is required to file a currency transaction report. So naturally, some people think, I'll just make smaller transactions. I'll deposit $8,000 here, $7,000 there. I'll stay under the limit. I'll keep it quiet. And that logic feels protective. It feels smart. It feels like you're simply managing your own money the way you see fit. But what you have just done legally on paper in the eyes of federal law is commit a federal crime. Not the tax evasion you were trying to avoid. Not some technicality. A standalone federal crime, carrying a sentence of up to 5 years in prison that has nothing to do with where the money came from. And the terrifying part, the part that should make you sit forward right now, is that you don't have to be intentionally structuring to get charged with structuring. There was a man in Iowa, a restaurant owner. He deposited his cash sales the same way every week, small amounts just under $10,000, because his bank had warned him years earlier about holding too much cash on premises. He was being careful. He was following advice. The morning the federal agents showed up, his account had already been frozen for 6 weeks. He hadn't done anything wrong. He hadn't hidden income. He hadn't evaded a single dollar in taxes. His accountant had records going back 11 years. Every sale, every deposit, every quarterly filing, clean. But none of that mattered in the first conversation with the IRS Criminal Investigation Division, because the burden in a structuring case doesn't work the way most people believe American law works. You are not presumed innocent in the way you imagine. The government seizes first. Then you prove yourself at your own expense with your own lawyers, on a timeline that can stretch across years. His name was Carol Hinders, not a restaurant owner in Iowa, a woman who ran a small Mexican restaurant in Spirit Lake, Iowa for 38 years. She deposited her cash earnings in amounts under $10,000 because her mother had told her decades ago that large deposits caused extra paperwork for the bank. She was trying to be considerate. The IRS seized her entire business account, $33,000, without charging her with a single crime. No arrest, no trial, no conviction. They simply took the money and told her she could fight for it in civil court if she wanted it back. She did fight. It took over a year, and she was one of the lucky ones. Between 2005 and 2012, the IRS seized more than $640 million from accounts just like hers, accounts belonging to people who had committed no crime beyond making deposits that looked, to a pattern recognition algorithm, like they were trying to stay under a threshold. A ProPublica investigation found that the majority of these cases involved legal source funds, legitimate businesses, honest people. And in most of those cases, the government kept the money without ever filing criminal charges, because under civil asset forfeiture law, they don't have to prove you did anything wrong. They have to prove the money did something wrong. The money is the defendant. And money doesn't get a public defender. This is where the emotional weight of this system becomes almost impossible to describe without sitting across from someone who's lived it. Because it isn't just the financial loss, though that alone can be catastrophic for a small business owner. It's the way the investigation wraps around your life. Your bank stops returning your calls. Your credit lines get reviewed. Business partners quietly create distance. You haven't been charged with anything, but the word federal investigation moves through a community like smoke. You can't see exactly where it's coming from, but everything it touches changes color. There was a dairy farmer in Michigan. His bank filed a SAR after noticing he regularly deposited between $7,000 and $9,000, the natural result of selling milk, which pays out in irregular cash amounts depending on the week. He lost over $30,000 to seizure. His farm equipment loan got called in during the dispute. He almost lost the farm itself, not because he was guilty, but because the system is not designed to quickly distinguish guilt from pattern. And here is where the authority of numbers has to anchor what might otherwise sound like isolated horror stories. The Institute for Justice, a nonprofit legal organization, documented that between 2001 and 2014, the Department of Justice's Asset Forfeiture Fund grew from $400 million to nearly $4.5 billion. That's not money taken from drug kingpins. A substantial portion of that is money taken from people whose only crime was depositing their earnings in a way that triggered an algorithm. The system is not broken. It is working exactly as designed. The question is whether you understand the design before it gets applied to you. So what do you actually do? Because this is not a video that ends with fear as the final product. Fear without direction is just anxiety. What you need is a framework, a set of behaviors that keep you inside the system's comfort zone without compromising your financial freedom. The first thing to understand is documentation. Every large movement of cash needs a paper trail that exists before the transaction, not after. If you're depositing business earnings, your point of sale records, your invoices, your receipts, those should be organized and accessible at all times. Not because you're preparing for an investigation, but because the moment you need them, you won't have time to build them from scratch. Think of it as financial hygiene, not paranoia. The second thing is communication. If you're going to make an unusual transaction, a large withdrawal for a real estate purchase, a series of deposits from a business with naturally variable cash flow, talk to your bank first. Ask to speak with a compliance officer or a branch manager and document that conversation. This does two things. It creates a record of your intent, and it breaks the pattern recognition trigger before it fires. Banks are not your enemy in this process, but they are passive instruments of a system that does not automatically give you the benefit of the doubt. You have to insert your context manually. The third is to know the number, not just 10,000, but the behavior around it. Never structure your transactions, even inadvertently. If your natural cash flow regularly produces deposits in the $8,000 to $9,000 range, consolidate them with documentation explaining the source. If you're uncertain whether your pattern looks suspicious, ask a financial advisor or a CPA who specializes in cash-intensive businesses. That conversation costs far less than the alternative. And finally, if you have $20,000 or more sitting in a standard savings or checking account doing nothing, you are not only potentially visible to the pattern systems we've been discussing, you are losing money every single day to inflation, while taking on every ounce of risk the system can generate around high cash balances. That money should be working inside vehicles that are both legal and structurally protected. High-yield accounts, treasury instruments, properly documented investment accounts, where the paper trail is built into the infrastructure of the account itself. The people who fear banks the most are the people who understand them the least. And the people who get hurt by this system aren't reckless. They're not naive. They're simply uninformed about the specific rules of a game they were already playing. Here is the rule that summarizes everything we've covered. The one sentence you should carry with you after this is over. Your money is protected by law only when it is documented by habit, not when it's hidden, not when it's moved carefully beneath thresholds. When it has a clear, legible, consistently maintained paper trail that tells the story of where it came from before anyone ever thinks to ask. The banking system is powerful. The forfeiture system is aggressive. But neither of them is designed to pursue people who are organized, communicative, and informed. That's the protection. Not fear, not paranoia. Just clarity about the rules, about your own finances, and about exactly what kind of customer you're choosing to be. Know the system, document everything, and never let a threshold become a trap.